So, Karan, welcome
Yeah.
once again. And today I wanted to do an entire episode on a new style of investing that is kind of gaining in popularity.
Mhm.
And more importantly, because this is something which we believe in it a lot, right? Like,
Mhm.
so all of our strategies are based on something called factor investing, right? So, I wanted to do this video almost like a introduction to everyone into what factor is to begin with,
Mhm.
and why is factor investing as an idea, as a philosophy of investing, why is it gaining more popularity compared to traditional styles like
Mhm.
value investing, buy and hold? So, begin by telling the viewers what exactly is a factor before you get into factor
See,
investing.
when you decide to invest in a stock,
Mm,
okay, you are look basically you have some money
mm,
and you want to invest in stock market. Look at different stocks
yeah.
and you look them across different dimensions.
Okay.
Okay, sometimes you look at PE/PB ratio
Mm,
or you look at EPS growth.
mm,
Okay, according to your bent of mind, you might look for ROE
right.
as well, return on equity, debt. Lot of parameters are available.
Mm,
Okay,
mm,
and there are a lot of videos on YouTube extra how to screen out a stock.
correct.
Okay, you might look at how the stock has done in last 3 months, 6 months,
Right.
12 months. You might look at some people go for stocks which have actually fell down in recent
Yes.
past by 30, by 30, 40.
Contrarian.
That's
Yeah.
contrarian view. Okay, uh, sometimes people go for stocks which have given consistent earnings across
Right.
economic cycles. Okay,
Dividends and
and some people go for dividends.
right.
Okay, screen for dividend yield and all and everything. All of these are factors.
Okay.
Everybody
Mm.
is doing factor investing in bits and pieces, okay,
Without
without
even knowing.
knowing.
Yeah.
Okay, so if you look at ROE, debt, and margins, that's your quality factor. If you
Right.
look at the performance of the last 3 months, 6 months, 12 months, that's momentum. If you're going for stocks which have not done well in last 3 months, that's contrarian.
Right.
Okay, look at PE, PB ratio, EV, beta, or any other way to value a stock. That's your value factor. Okay, stocks which have done well in a down cycle, okay,
Mm-hmm.
or during
Mm-hmm.
the bearish phase or recession in terms of profitability and stock returns, that's your low wall factor.
Right.
Okay, so uh, you are already doing it,
Mm.
okay, without knowing it,
Mm.
and it is becoming popular because see, buy and hold is not very easy for
Mm.
regular investor
Mm.
in general.
Mm.
Okay, uh, let me give you an example. So let's say you select ITC to be a top quality pick.
Right.
Okay,
Mm.
today,
Mm.
as of today, you say the ITC is my top quality pick, and I believe its quality will lead to alpha over the long term
Right.
with respect to Nifty 50 index. It
Right.
will give higher
Right.
returns.
Right.
Okay, that's why you're selecting it. Otherwise, you will go for Nifty 50 ETF,
Correct.
which is easily available. Uh, but businesses, ITC as a business would evolve over time.
Mm.
Okay, there would be quarter results,
Mm.
annual results. It's quite possible that ITC would took some debt
Mm.
and acquire a company, acquire a US tobacco company,
Right.
or acquire a Chinese hotel chain.
Mm. Mm.
Okay, its fundamentals would change.
Change. Correct.
Okay,
Correct.
it might not be a quality pick at all. Okay,
Maybe
but
5 years down the line,
5 years
7 years.
down the line, but people who are fed on stories of legacy investors like Warren Buffett, or
Mm.
even if you look at closer to India, Rakesh Jhunjhunwala
Mm.
or Ramdev Agarwal,
Mm.
who hold on to their picks for 15, 20 years, keep
Right.
money, keep putting money during the
Right.
bad times and make generational wealth.
Mm.
It would be very difficult
Mm.
for investor to part way with it in
Right.
general.
Right.
Okay.
Mm. Mm. Mm.
Uh, what factor investing would do, how
Mm.
factor investing would avoid this pitfall,
Mm.
ITC would be there as top 10 quality picks.
Mm.
Okay. Every year you will rotate into 10 best quality businesses. Okay.
Right.
You are saying that you are not selecting ITC because you love ITC or you have some emotional attachment with ITC. You
Mm.
have selected ITC because its quality would create alpha for you.
Yes.
So basically quality is harbinger of alpha, right?
Right. Right.
So you will keep capturing quality. You will select top 10 companies.
Mm.
The next year ITC might not be the best quality pick.
Right.
So you will shift to a better quality pick.
Right.
Okay. So
Right.
it will ensure that you will always remain in quality. If you talk about the value investing, it's not exactly a science. It's
Yeah.
more of an art.
Mm.
Okay. So value investing people typically go for, let's say, PE PB ratio, look at EV beta multiples. Okay. there is a nearly 99% chance that you will end up in a value trap, and you would end up with nearly 0% returns for decades. I'm not saying years, I'm saying decades. So let me give you one example. So like PSU banks in 2011, they were giving great dividend. Dividend yield was around 5 to 6%. Okay. Growth was also quite good at that time. Around 20-30% credit growth was there. Okay. If you look at the valuations, they were trading at 40% of their book value. 30-40%. That's deep in value for a company that is growing pretty well. Okay, that is giving good dividend yield. Okay, so that's deep in value. Okay, so market is not stupid. Okay, would ignore that. We are living in era of massive computational power. Okay, huge coverage. Okay, these PSU banks, which form critical part of market. It's not possible markets to ignore those aspects. That is a deep in value. They were deep in value because market believe that 50% of their books is NPA and numbers are not correct, which actually turns out true eventually 5-6 years down the line. And
so someone who is buying into that value story in 2011 falls into one massive value trap.
Every investor has its own definition of value, how they evaluate. Sometimes people, even Warren Buffett has bought high PE companies in name of value because he believes that current valuations are not reflecting their true valuations. There is no straitjacket formula. Okay. So these kind of buy and hold and value investing strategies that we hear about legacy investors, where those stories are true. Those are great investors, great people, but you have to also see that they have a horizon of 15-20 years. Even if they can take a bad call, they can survive for 5-10 years. They will stand by it. They take a position for 2 decades. For a generation normally. A normal investor would lose hurt in 5 years. Okay. If Nifty 50 is going up, let's say every year by 10%, your portfolio is stagnant there. Okay. After 5 years, you have 0% return. You feel that, okay, even FD would have given me 40% return. You will basically liquidate. Okay. So these are quite complicated strategies. These are not suitable for normal investors in general.
So again, to circle back to saying what about factor investing, which it does, is that it is not getting focused on a particular stock or a particular company or sector. It is focusing on the underlying factors that actually drive characteristics which are driving those alpha possibilities.
You basically figure out which are the characteristics which have traditionally, historically, have given a consistent, reliable and sustainable alpha. Okay. And then you create the strategies in line with capturing those particular factors or characteristics. Okay. You will say that I will remain rich in that particular factor across the board. Which will create a long-term alpha for me. In general, if you look at the factor portfolios, Nifty also has some factor indices on momentum, quality, volatility. If you look at long-term data, 18-year data since 2005, okay, literally every single factor has outperformed Nifty 50.
The factor indices.
Okay. So if you look at momentum, it has given, if you invested 1,000 rupees in 2005, it would be 30,000 rupees right now. In
compared to a
Nifty would have given you 10,000. That's the big gap you are talking about.
3 times.
3 times. Quality would have given you 21,000. Okay. Low vol would have given you 18,000. Okay. So there are decent gaps, big gaps. Gaps would matter. Okay. That are there with factor investing. Okay. Having said that, different factors work in different market environment. Okay.
Yeah.
If
Yeah.
you see volatility factor typically it's alpha over the benchmark typically expand.
Mm.
It expand during the bad times, during the bear markets,
Right.
and contract during the bull market. Sometimes it's also negative in bull market. Okay,
Mm.
so if you are holding, let's say, low vol strategy since 2021, last 3 years have been pretty bad.
Right.
You have been actually underperforming the benchmark.
Mm.
Okay, let's take example of momentum.
Mm.
Now, momentum is a bull market strategy.
Mm. Mm.
So let's say you enter momentum in 2007 at the end of
Mm.
2007. So you will remain, you will see a massive drawdown
Right.
of nearly 70% in 2008. Momentum would never recover. Nifty actually recovered, then went down again in 2011 after 2007.
Right.
But momentum would never recover till 2014. Okay, for
7 years.
7 long years, you're sitting on underperformance, negative returns. Okay, where inflation is as averaging around 10%.
Mm.
FDs are giving around 10%. Even Nifty is giving around 6%. Okay, you are sitting at negative to 0% returns. Okay, and it's very difficult to top up at that time. People say that, okay, I would have topped it up, and
Yeah.
it
It's
doesn't.
easy to say in retrospect.
It's
Yeah.
very difficult when markets are down. It's very easy where markets are making new high to put money than putting money when it's down.
So this
Okay,
is actually
and
very.
these are 5-7 years a decent period.
Mm.
Person can easily lose patience.
Yeah.
Okay,
Mm.
so 15-18 year record is good. Long term factors are good, but factors also come with the timing risk.
So this is very interesting. What you say is that even if you look at factor indices, which is pretty much available by which even Nifty puts out,
Yeah.
had you even invested in a factor indices, but over a period of like 18, 20 years,
Mm.
then you have done sizably well compared to your typical Nifty benchmark,
To mention,
right?
yeah.
But the critical but there is that not every factor is going to perform all the time.
Mm.
And in fact, if you have just picked one or two and just put money for long term, there is a very good chance that you could have even underperformed the
For
benchmark.
5-7 years, 5-7 years
Right.
is a decent period.
Right, exactly.
It's a decent
Exactly.
period, yeah.
So, which brings us to the next question. So, while there seems to be a very good alpha possibility when it comes to factors,
Mm-hmm.
right? But they also, from what you're saying, comes with a sizable timing risk as well. So,
Mm-hmm.
how does one solve for that?
See, problem with factor is long term alpha is there.
Mm,
Okay, it's
mm,
definitely there. It's sizable.
right.
But the problem is, if you go for medium term, 3 to 5 years,
Mm, mm,
alpha is uncertain, is
right.
unreliable.
Right.
Okay, factor investing can work for people if it is a all season alpha. Okay,
Right. Correct.
if we can introduce that alpha, reliable alpha in 3 to 5 year period.
Right.
Okay, and that's where factor rotation comes in.
Factor rotation. Right.
Yes.
Right.
So basically, in good times, you shift into high risk factors.
Mm,
Okay, you add on the risk when
correct.
risk is low.
When the market
Okay,
is booming.
market is booming and risk is low. You add on the risk
Mm,
because at that time for high risk factors, alpha expands.
yeah.
Okay, in bad times, you rotate into low risk factors because at that time alpha is maximum.
Now, of course, no. This is very easier said than done. I would assume that when the market is booming, you go into high risk. When the market is low, you go into low risk. Of course,
Yeah,
it is not
buy at bottom and
buy at bottom and
sell
sell
at
at.
peak.
Yeah. It's very easier said than done. But then, how does it actually work in real for it to really make sense? How will you implement this?
So there, typically researchers develop quant model to identify the market signals.
Right. The
Different
other
quant model,
buzzword.
other
Yeah.
buzzword, yeah.
Yes.
So let's understand what quant model is.
Mm.
Okay. Typically, people go to historical data which they feel is relevant.
Right.
Okay. Sometimes government bond yields.
Mm.
Okay. Multiples,
Mm.
earning growth.
Mm.
Okay.
Mm.
Uh, interest rates,
Right.
government interest rates.
Mm.
Okay. Consumption data, inflation data. They take a historical series
Right.
and they run a series of tests. Okay.
Okay.
To identify data patterns.
Okay.
Okay, and these data patterns are coded into some mathematical rules.
Okay.
Okay, And these mathematical rules are wrapped into a model that we call quant model. This quant model is typically a predictive model, okay, that give us necessary information about future market movements
based on the historical data that you have used.
Yes.
Okay.
And sometimes models also become obsolete.
Mm-hmm.
Certain fundamentals change, it also become obsolete, then the models have to be updated.
Right.
And that's where people also use AI, where the model
Right.
basically use the new information and it keep
The learning model.
it's
The-
learning model, it
yeah.
keep evolving itself.
Okay. Okay. So now I just want you to kind of help us understand with a example of everything that you just spoke, like the factor portfolios that actually pick the kind of stocks in different market conditions,
Mm-hmm.
to the quant model that can kind of give you that signal
Mm-hmm.
of how the market could possibly move and how the rotation actually happens. Can you break it down in one illustration for everyone to understand?
See, typically factor portfolios and quant model are used together,
Okay.
okay,
Right.
to generate investment decisions.
Uh,
Okay. Let's say factor portfolio are Nifty indices only. We have volatility index and momentum index.
Okay.
Momentum is high risk, volatility is low risk.
Great.
Okay. And we have a technical model, okay, which is generating bullish and bearish signals. Okay.
Okay.
Where the market is going to be in medium to long term, take a bullish turn or bearish turn.
This is the quant model.
This is a quant model.
Okay.
Okay. So in from 2000, we are starting from 2005. 2006 is a bullish signal. 2007 is a bullish signal. 2008 is a bearish signal. I'm assuming that our signals are correct.
Right.
Okay.
Of course.
Okay. So in 2009 it's consolidation. We are considering consolidation as bearish only.
Okay.
Okay. 2010 is bullish. 11 is bearish, and so on. Okay.
Okay.
And so on. So basically, in bullish signal, when there is a bullish signal, we are taking position in momentum, and when there is a bearish signal, we are taking position in a low wall.
Right.
Okay. Now, if you look at the data return profile from 2005 to 2023, if you consider volatility in isolation, alpha over Nifty 100, Nifty 100 index, large cap index, is around 3% annualized alpha.
Okay.
In 8 out of 18 years, 10 out of 18 years, it has beaten the benchmark, given a positive alpha. In 8 out of 18 years, it has given negative alpha.
Right.
Okay.
Okay.
And negative alpha also goes up to 10, 12, 30, even 30% in some cases in bullish markets. Okay. Basically, negative alpha is concentrated in bullish markets.
Right. Of course.
In case of momentum, okay, alpha is around 5%. Okay, it's larger. Okay. Analyze alpha. In 4 out of 18 years, it has given negative returns. Okay. But those negative returns are again they're extreme values. 15%, 20% negative alpha is there.
Okay.
Okay. But let's say we rotate between these two strategies using a tactical model.
Right.
Okay. And tactical model is working perfectly fine.
Right.
Correct.
That's the assumption. Yes.
That's the assumption.
Yeah.
Okay.
Okay.
So alpha increased to 10%. Okay.
Annualized alpha.
Annualized alpha increased to 10%. Negative alpha is present only in 2 out of 18 years. And there also that negative alpha is quite negligible. 3 to 4%.
Okay.
That's how factor investing and tactical you
Quant
can
model.
say the quant model, okay, together create value for investors.
Right. So factor portfolios basically put you in line to create that alpha, provided your quant model has given you the right signal on what kind of
You can
portfolios
simply
it
say
should be.
that the factor portfolios give you long-term alpha. But if you want to create a all-season alpha for 3 to 5 year holding period, you mix it with a quant model.
Right. So for all the viewers out there, if you want to understand this in a little more detail, we have a video which is entirely around our PMS, which goes into a minute detail of how these factor models and the quant model work together to create the kind of alpha that we're talking about.